one of the things that has happened since on the neighborhood front is that these properties have been for sale for, frankly, a number of years now. The reason we were able to purchase them now is because we were able to get them for the right price, finally. And I could tell you the whole neighborhood is calling me, asking me whether I know who purchased these properties. Which is positive because then I could kind of manage the neighborhood in terms of what we want to do with these with the properties. What has happened since? Well, in terms of just operationally, we've applied for a permit for 28 Winona. We're going to put a triplex on that property. My expectation is that we should have the permit probably by second week of May, and which works well since we take possession at the end of April. So I'm looking forward to kind of getting started on that property. In terms of the rest of the properties, as I wrote in the newsletter, we've staggered the closings so that we close on the larger portion of it on the Alberta side in October. That allows us to kind of spend the next 6 months really canvassing the neighborhood.
And Hooman, just for the listeners, I want to make sure everyone's on the same page. When you say Alberta side, you're not talking about the province.
Alberta Avenue.
Right. Right. Got it.
We focus solely in Toronto. So.
Right. Alberta Avenue in Toronto. Got it. Yeah.
So that gives us time to be able to really, once we take the possession of the property, to hit the ground running. To kind of go into some basic detail with you, our base case scenario, which is as of right, which essentially means that we don't really have to fight an uphill battle with the city, is to add an additional story on those two properties and take them from the current 9 units to 12 units. And that enables us to achieve a 4.8% cap rate, frankly. And that's us doing nothing with the land behind. However, as many of you know, the City of Toronto has just passed a bylaw regarding garden suites, which actually is under appeal, but hopefully pass through. And that enables us, frankly, again, without having to go to committee, to put at least 4 garden suites in the land that's in the middle of that laneway. So I'm excited. It allows us to build a community, allows us to kind of really focus on what we do best, which is create boutique elevated, residential units. So I look forward to sharing more as time goes on and we have more information.
Yeah, indeed. And I think there's a lot of excitement going on here to talk about, and not the least of which is some information that I'd like to quote from TREB President Kevin Krieger. I'll quote what he says here. Mr. Krieger says, the lack of housing inventory is not just an issue for the ownership market in the GTA. After a relatively brief pandemic-induced blip in rental supply, available rental listings have declined. He goes on to say that this has made it more difficult for would-be renters to find a place to live. Essentially, you can't rent what isn't available, he says, and by extension, the lack of inventory has also resulted in increased competition between renters, pushing average rents higher. I wanted to talk about this a moment, Hooman. Could you share with us how this decreased rental supply of available rental properties and increasing competition between renters is impacting Alliance REIT? And specifically, what I'm curious about here for our listeners and our investors is, are we seeing a different type of tenant who's able and willing to pay more to live in your boutique residences? We'd love your feedback and commentary on that thought.
The short answer is yes. The long answer is, we're a very privileged position, our company, by virtue of the type of units that we provide. I wouldn't want to be in a position where we feel like we are taking advantage of the rental market. But reality is that throughout the pandemic, we were fully occupied because what we saw was a bit of a flight from a more dense condo environment and apartment buildings into our units. We did have a number of students, etc., or people who worked for the government who decided they're going to kind of go live with their parents in a cottage, etc. So we had some vacancies, but those vacancies were filled immediately. What we're seeing now, Declan, which actually took me by surprise, if I'm honest, is frenzy of competition for our
Mhm,
units.
mhm.
I'll give you an example, an anecdotal. There was one unit on 4 Marchmount Road, 2-bedroom, 2-level loft that came available. And on Sunday, I showed it to 3 people. We listed it for 2770. The second person, as soon as saw the first person, filling out an application, said, "I'll offer you $3,000." And they're just as
Wow.
qualified.
Wow.
So we I am seeing. Again, it's I want to kind of temper by saying we are very privileged in terms of where we are sitting in the market. But yeah, we're fully occupied, and our units are really flying off the shelf at prices that I frankly didn't expect we would be able to achieve.
As I listen to this from a position of leadership and understanding uh, business models that we want to invest in, I always ask the question about sustainability. You know, by your own surprise, as you've articulated, this isn't something that you anticipate will continue, is it? Or what do you sense based on what you're seeing now? How long do you think we have to enjoy these sorts of unusual demands at this
Mm.
level?
I fall in the category of folks who believe supply is the cure. I
Mm,
think
mhm.
hopefully as more and more units come on line, hopefully it dissipates some. However, I'm also reminded by the fact that the demographic immigration into the city far outpaces any sort of supply that we could have in the core, maybe in the suburbs, but as you know, we focus on the core. So frankly, if I'm honest, I don't really see it dissipating anytime soon. And if you take into account the rising interest rates environment, which means more people, may not be able to afford a home, which is more people have to rent. And so I don't really see it dissipating unless there's some sort of political risk. But I don't. The rents are going to continue going up, particularly with inflation being where it is at right now.
Your comments are in line with the chief market analyst Jason Mercer over at Trub. He was saying that demand will increase both immigration and temporary migration into the GTA picks up over the next year. And both sources of population growth result in more demand for rental accommodation. And in the absence of a market increase in supply of rental units, we are to be expecting average rents to continue to trend further upward in 2022. And just on your topic of immigrants coming into Canada and into Toronto specifically, where we're focused on for Alliance REIT, here's a thought, and this is why I asked about the type of folks you're seeing renting your properties. Immigrants make up about 37% of pharmacists, 36% of physicians, 39% of dentists, and 23% of registered nurses, and 35% of nurse aides and related occupations. So we're seeing folks that are coming into the country that are making a significant contribution economically, and they
Yes.
have the means, and they're once again they're going to be competing with each other for your properties, which I find fascinating. How is Alliance REIT positioning to benefit from this increasing demand for quality rentals in the GTA? Any plans to look beyond Toronto? Maybe not this year, but in the coming year or
Yeah.
so. Hmm.
Um, Great question, and exactly what we discussed kind of at our strategy meetings with the board. Right now, in the um, eh, considering our resources, we were able to, or we have been able to find, as you say, infill sites to be able to develop additional units.
Hmm.
So what's our strategy? Our strategy is to keep building more because the more we build and the newer they are, the more the income stream increases, for the REIT, and be able to, add to the portfolio and scale. However, with the rising interest rates, we are looking in the Hamilton area, so at GTA. I think Hamilton shares, I mean, this, I don't have to go into it. Hamilton shares a number of traits with Toronto, particularly in the type of buildings in downtown core in the year of build, which is kind of turn of century. Right now, many were dilapidated. Obviously, Hamilton has gone through a bit of a huge gentrification the past number of years. But my expectation is that if there's going to be a price shift, we're going to see the biggest impact of that decrease in the periphery. I don't think we're going to see as much of a decrease in the Toronto core. I
Mm.
think where we're going to see a decrease in prices, if there is to be one, because that's in itself a question, we're going to see it in Hamilton, Kitchener, Oshawa, places where prices have appreciated exponentially in the past number of years. So we are looking actively in those markets, and if we are going to go into those markets, we want to do it right. We want to be able to kind of create the team that we have in Toronto, and in Hamilton, let's say. And I am in conversation with a number of guys who live in Hamilton for them to really be able to be our feet on the ground there. But I wouldn't say it's immediate. Definitely within the next 3 to 4 quarters.
You raised an interesting point about boots on the ground and finding quality talent that can support the Alliance REIT brand. At Pangea, we're aware that in some markets, finding labor, i.e., people who want to do the work, is proving to be a challenge in some areas. I'd love to invite your leadership perspective on this. And I know it's a tough question, but I think as investors and folks who are paying attention, we have to ask it. I want to ask this of you. How are workforce challenges like labor shortages impacting Alliance REIT, if at all, if at all?
Thank you. Well, now you're gonna make me give away a secret sauce. Um, Listen, for good or bad, I care for my crew. So we have our own, internal crew,
Mhm.
that, are, part of our development. So obviously, as you know, we're not just a, real estate rental company, we're also a development company. So we have at this point probably about 12 people that work for us, full time.
Mhm.
And then also probably just as many, if not more, of what I call just-in-time labor, where they prioritize us when we need them. These are roofers, electricians, plumbers, specialized trades, HVAC. And if I'm honest, I've built these relationships. I don't haggle. I don't try to squeeze contractors. I think they're worth their weight in gold in terms of the skills they have, and when they come and they problem solve, and we treat them right. And in turn, we find that that's why we're able to turn a property from demolition to finish and tenanting in 6 months.
Wow.
Is really because of them, not because of me. I, I protect them. I don't share, I don't share them with anybody, and that's how we move forward. But you're right. I think our, if you're asking me, and you may ask this, what I see as our headwinds coming up,
Mhm.
really it's labor shortage, it's supply chain, it's material shortage. I can't tell you how difficult it is these days to get appliances. Used to be that, we would call, one supplier and they would have, 5 fridges delivered. Now I have to call, 6 or 7 guys and get one from this guy, another one coming in 3 weeks because there's no supply.
Mm. And I appreciate you bringing up the conversation around headwinds because I think it's important for us as investors and folks who participate in supporting the success of Alliance REIT that we're aware of what some of the challenges are, but more importantly, not only being aware of the challenges, but I'm going to have to position this question to you, but what is your team and what is the governance board doing to mitigate risks that impact Alliance REIT that we're aware of, like these headwinds that you mentioned, supply chain
Hmm.
issues, etc.
I mean, it's being able to pivot, and be flexible. I think that's probably our biggest asset in terms of how we're able to move forward. Like, I'll give you a basic example.
Mhm.
We're building 1150 Davenport Road, which I can't wait to finish so I could invite all the investors for a party on the patio this summer. But here's an example. In the summer, we could not find LVLs. And LVLs, for those of you know, are specialized lumber that are able to bear much more weight than typical labor, and they're kind of used for structural framing. You couldn't find it. You just couldn't find. And so what we had to do, obviously in conversation with our engineers, is we the building that we were demolishing had these true 2 by 12, like back in the turn of century, the 2 by 12s are true 2 by 12. Now it's like 1.5 by 10. So we ended up salvaging those, and the engineer signed off on reusing, kind of putting tree plies instead of LVLs. So one, from an environmental perspective, I think, they avoid going to landfill, but it's also being able to think on our feet instead of kind of having the site sit dormant. We were able to kind of like, pivot and be able to use material that, was able to kind of move us forward. So that's one example. In terms of rising interest rates, we, even though our declaration of trust allows us to go up to 60%, LTV, as you know, I don't like
And
that.
I know you're sharing something really great. I just want to make sure everyone is following along. LTV for the folks on the call, loan to value, and folks who are on the call who have a mortgage would recognize that loan to value LTV acronym. Back to you. Over to you.
Thank you, Declan. I'm sorry about that.
No.
And so we maintain a 40, right now we're about 47, 48% loan to value.
Wow, that's
Because,
incredible. Mhm.
and our average interest rates is about 3.7%, and most are in 5-year fixed. So these are all the things that, even though we were in a very low rate environment, the board and, as me kind of part of it, kind of, we were able to kind of look ahead. Well, we're not always going to be in a low rate environment. So let's mitigate some of our risk. So that's the risk. If you guys really want to know what the biggest risk I see,
Yes, please.
honestly,
Yeah, sure.
it's political risk, which we have no control over.
Mhm.
Um, is some discourse that is happening, within certain circles, that, speak about, housing as of right, and housing as, and rentals should be kind of, regulated, etc. Um, I don't know how much of a risk that poses, because at the end of the day, we are providing a public good. We are creating rental stock out of properties that were, otherwise, underutilized. And, we're not charging exorbitant rents. But there are some, discourse happening in terms of regulation and taxation, etc., that could possibly affect us. So that's something that we're looking ahead in terms of kind of gauging and, frankly, engaging, to make sure we're mitigating any risk.
I appreciate that very much. And you brought up interest rates earlier and this political risk. So why don't I go there with you now, just for a moment. The Bank of Canada Governor Tiff Macklem, in March of this year, he talked about the bank's decision to raise its policy interest rate. He even explains that after 2 years of extraordinary stimulus, we're now on a path of rising interest rates, and citing that tighter monetary policy is necessary to lower the parts of inflation that are driven by domestic demand. And it's critical, really, to bring our price increases back in line with our 2% target inflation, is where the Bank of Canada's mandate is. Inflation at the numbers that were published in March were at 6.7 or so significantly higher than the target. Now, you talked about interest rates in the portfolio for the properties being in fixed 5-year rates. And I wanted to ask the question maybe in a different way. Are there other parts of the Alliance REIT model that are interest rate sensitive, maybe your short-term or mid-term borrowing costs, for example, which have an impact on profitability, et cetera?
Of course, of course. We do have a line of credit,
Okay.
it's an acquisition line of credit,
Mhm.
which is at a variable plus 0.5, which is very reasonable still.
Mhm.
But I mean, so yes, I mean, if right now it's not fully drawn, but we use that line for our acquisitions, for example, the one that's coming up, and then we pay it down as we raise equity throughout the year,
Mhm.
because it's payable at any time. So absolutely, I think if that it's a $5 million line, if that line is fully drawn and interest rates get out of hand, yes, there's definitely some exposure for us.
Yeah. And what I like about your response here is that this is a controllable expense. You can determine when to, and you're not locked in. And that's what
Yeah.
I find some level of comfort in. As we think about the remainder of 2022, what I'd love to invite, Hooman, from you is any additional leadership insights. As you look out across the coming quarters of 2022, I'd love for you to provide some insight to manage investor expectations for Alliance REIT in the coming quarters of 2022.
Thank you. Um, I wish I had a significant shift in thought, but I guess I'm happy, elated that our original strategy and original plan is working. Toronto, by virtue of its age and history is on a trajectory where it is only going to become more dense.
Mhm.
And our strategy, frankly, if I'm going to, I'm diluted to, any is, we buy Toronto land. We buy Toronto land, and we rent them, and we're able to get great rent while we hold them. And these are going to be very valuable properties in 5 to 10 years' time because, as it is, the city of Toronto is continuing to increase density on avenues. It is now 8 stories. It is going to continue increase the density on streets up to 4 stories, much like any other metropolitan city you see in the world. Our strategy is holding, to the extent that we focus on our core strategy, and it is buying properties in gentrifying areas in downtown Toronto, and being able to really put them to best use in terms of rental. I know we talked about this a couple of years back, Declan, in terms of, walk-ups in Boston. Where in Boston, for example, in Franklin, New York, it's very tough to find a, detached house with a white picket fence and backyard, right? At best,
Sure,
you have a walk-up. You have a
sure.
walk-up, you have a story, 1 story of a building, and then, frankly, you're very well off, right? That's what we're building in Toronto. We're building those properties, right? We're taking detached properties and we're dividing them into high-end elevated, you know, 1 to 2 story living spaces. So I think what we're doing is very much future oriented. So I'm excited. I'm excited to see our performance. And, my job and the board job is to really put our head down, try to drown out the noise that, obviously there's cyclical noise here and there. Interest rates goes up, goes down. But be able to focus on that core strategy.
Thank you, Hooman. I'll invite anyone who's on the call, if you'd like to use the chat feature to type in any questions that you have there. I'm happy to pick them up and reflect them back to Hooman. If you'd like to type them into the chat or make any comments, I'm happy to share them with the broader group if you'd like to use that function. Hooman, as we look to wrap up in the remaining few minutes of this call, you know how I feel, how I celebrate the Spadina Road acquisition. I really love that building because of its heritage, characteristics, and the history there that you have. Any updates that you can share back with us as we look to conclude the call on a positive note with some additional Alliance redevelopment stories?
Yes. So if you recall, we bought that property for Spadina Road on in May, I believe May 28th. It was May 28th of last year, 2021. Our original plan was to be able to turn 16 units within 2 years. And
Mhm.
by turning, it was a property, just to kind of like, for folks who don't have the background, it was a property that was held by in the same family for over 80 years. A magnificent property. It was built by the same architect who built all the Cineplex Odeons in Toronto. But
Mhm.
the family, frankly, didn't really, keep up. I think all they did was kind of put a coat of paint, for the past 90 years. So there's a lot of update to be done, plumbing, electrical, etc. Laundry in each suite. Um, I'm excited to tell you that we've turned 16 units in less than a year.
Oh my
We finished
gosh.
it. It's done. Everything is rented. There's 2 units that are just finished and are going to be rented. Our expectation originally was that we're going to be able to get an average of 1,900 per door because these are kind of one-bedroom apartments. Again, I'm privileged to tell you we're getting an average of 2,150 per door.
Oh wow. Yeah.
So it was a success. I'm very thankful.
Really great story, success story to share back with everyone. We've got a comment, or a question rather, in the chat from Jackie. She asks, how are you managing the higher cost of supplies?
Hi, Jackie. Great question. It's unavoidable. Costs have certainly gone up. I mean, I could tell you, I mean, just in basic, a 2x4 used to be like $12 now. It's like you're paying $18 for a 2x4. Um, but at the same time, everything's gone up. So our prices, whereas before, frankly, if we were able to develop a property for maybe 350,000, now we're looking at it 450,000. So that also comes into kind of a cap rate suppression. Whereas before we were able to routinely hit a 5% cap rate, now we're hovering around 4.7, 4.8. That's really all because of rising cost. And frankly, the biggest cost is the price of the house, not necessarily the material. One thing I would, to again, our secret sauce is that when people renovate and build properties, the biggest cost component is often labor. Material obviously have a cost to them, but labor seems to be, I would say, a big chunk of that cost. Because our labor is on salary, that's something that we control. So the increasing costs, I wouldn't say have had a detrimental effect on us. I think not being able to source them is more detrimental, which kind of force us to have to wait and pivot, try to find material from elsewhere. I think the one thing that has affected us is frankly rising price of properties. I hope that
Yeah,
answers the question.
yeah, I appreciate that. I mean, it's a curious thing to manage when you have no choice. Like you have to pay for these materials. And I think to Jackie's question, one of the things that may arise in your governance discussions is as supplies remain at elevated levels, the cost of supplies, I don't know, maybe at some point your engineering team is going to be looking for alternatives. And that's probably even a discussion happening now because you talked about the different type of that uniquely engineered board that you're using.
Yeah, I mean, one of the things that we're doing, I mean, it's always the little things, at least for me anyway. It's always kind of, I try to save money everywhere, every quarter, right? So that's it. So for example, I'll tell you, sometimes, I see a deal on vanities at Costco or Home Depot, right? So I sent guys and we get like 30 of them, right? $99, because sometimes they want to kind of clear out the inventory. So that's how we save money, right? Because I'll tell you, if I was going to buy a vanity each time I needed one, I'm paying $400, $500 a vanity, right? But when we're able to kind of get them on clearance and it's exact same ones that we get, a full price, that's how we save money. It's a bit more labor intensive. We have to kind of manage storage and inventory, etc. But so far we've done okay.
Appreciate it. As we're just down at the time committed for this call, I wanted to reach out to the listeners and the participants just to ask one last time if you had any final questions or comments that you wanted to leave in the chat. I'm happy to reflect them back to Hooman for you. And as we look to wrap up this call, I wanted to express to you, Hooman, a deep word of gratitude for your time and expertise. Thank you for taking the time for this call. I know you're struggling with a bit of a cold and you're recovering and you're even in quarantine from your family. So I appreciate
I dare
you doing
not give my
this.
children cold because that means they have to stay home, and that's just not good.
Yeah,
Listen, I want to thank you, and I want to thank everyone on the call. At the end of the day, guys, we could not do this without you. This is your capital. This is your homes. This is your money that are gracious enough to allow us to utilize to be able to create this profit. So I thank you, and I'm indebted to you. And if there's ever anything you guys need, I'm always available.
I appreciate that very much, Hooman. And we're getting some comments here from Jackie, and I'm sure others are saying thanks for the update and the outlook.
Great.
Thank you again very much. And Oscar, thank you for your feedback. This particular conversation will be archived and be made available to you with a follow-up email via recording access. So thank you all very much for joining us this evening, and we'll be in touch in the coming weeks. Bye-bye for now.
Thank you, everyone.